Jeff, let's get to your first pick. This is relevant right now. It is Cheniere.
Yeah, very much relevant given the news that we just heard. Listen, this is a stock that I think technically looks pretty good. It recently broke out to new highs. I think it could retest those 150 levels, but I think that would be an opportunity. And in this environment, what do you want? You want stable, visible cash flows. And I think given the nature of their long-term contracts, that's what you have with a stock like Cheniere. The stock keeps going up. The PE keeps falling as the fundamentals get better. The stock's trading, I think, at 11.5 times forward earnings right now. Obviously, some of that has to do with LNG prices going up. That is helping. But I think an important part of the story is the fact that sales volumes are also going up. I think that that's really, really critical. And I think you have more growth to come. They're expanding one of their larger facilities. And then thinking longer term, if you look out to Asia, they're projecting a 40% increase in LNG demand out to 2030. And they've also paid down over $1 billion of debt this year. Important for a company like this who tends to carry a high debt load. So I think you take all of those things in combination, it's a pretty good story.
It's a good case, despite shares being up nearly 60% this year. Next up, Jeff, Merck, pharmaceutical giant, is up 14% this year, and it is outperforming competitors like Pfizer and Johnson & Johnson. Jeff, you say that this is a solid stock to buy. How come?
Yeah, big cap pharma is sort of interesting. You're seeing a divergence there. You've got the likes of Pfizer, J&J sort of breaking down, but then you have Merck, Lilly. Those charts look really good. So take a chart like Merck and Pfizer, for example. Merck just looks far healthier. You've had this multi-year base in the stock. It's trading above its 200-day moving average, whereas a Pfizer, for example, sort of looks like it's rolling over. And even with the outperformance that we've seen in Merck, it's still below its 10-year average in terms of its PE ratio. And just from a fundamental perspective, really solid drug pipeline, particularly in oncology. And again, back to sort of profitability, margins, cash position. These are the types of things you want in this market, and I think Merck has it.
Finally, Jeff, let's get to Danaher. It snapped a 4-day losing streak yesterday, but shares are still down 16% in 2022. You say this name is still a buy?
Yeah, I think it is. And it's one of these things where healthcare overall, it's sort of tough market, good charts. And I think you have a lot of good charts in healthcare. So whether it's a name like Cigna, Humana, UNH, but then Danaher, I think also is one of them. You've had really solid support around that 250 level. Again, like you said, still 20% off its highs, so room above it. And it's holding that recent uptrend. So overall, I think the chart looks pretty good. And just for those that don't know, these guys make drug equipment. So for disease testing, vaccine development, a lot of things tied to biotech and R&D spending, but it's a lot less risky. And I think because of things like gene therapy, vaccines, there's big thematic tailwinds for a name like Danaher. They have this large equipment install base with a lot of these companies, but then that drives the sale of their consumables, which are at higher margins. That's about 75% of their sales. And I really just think the key with a stock like this is really great management that's proven they can sort of navigate all kinds of different environments and the recurring revenues that's associated with the business I described. So another good one, I think.